Okay, this weekly economic and market update, looking forward to the week of October 2nd. Um, this past week, there are a lot of headwinds to the markets right now. And we have a pending government shutdown, which technically probably, shouldn't affect things too much, but I think it's just a combination of things that are headwinds to the markets. There's the government shutdown, there's the auto strikes, we have higher 10-year yields, which leads to higher yields across the board for borrowing purposes. We have a very strong dollar, and crude oil, although it backed off a little bit today, for the most part, it had been going up. To really high levels, which we'll take a look at a little bit later. But I wanted to start with sentiment. I haven't talked about sentiment in a while. And right now, taking a look at this, the fear and greed index sits at 29. But at one point, I don't know, well, let's just take a look here on the timeline. We were down to 24, which is pretty low. Last year, I think we got down to 13, but 24, pretty low. Started to pop up a little bit today. We had a little bit of rally in the morning after the PCE report, but it didn't stick, and the markets collapsed a little bit as the day went on. Then the investor sentiment survey, you can see a lot more bearish sentiment right now. There's kind of this negative overhang, and it's kind of been there since last year to the markets. But every time we seem to try and move the markets up forward, things start to turn back. Economic calendar. Let's take a look at this past week, and manufacturing continues to be really poor. The Dallas Fed Manufacturing Index, I think we had the New York, came out higher than expected one time. It was like an anomaly, and then, but for the most part, manufacturing has been very weak. The Consumer Board Consumer Confidence came in lower than expected. This kind of helped get the markets going a little bit this week, but everything was really dependent on some of the reports like the PCE and some of those things. But we also had new home sales here that came in lighter than expected. Mortgage rates, as I mentioned earlier, kicked up. Durable goods came in a little bit stronger than expected, and the GDP growth came in as expected. Initial jobless claims a little bit lighter than expected. Pending home sales was much worse than expected. Year over year, down 18.7, and just month to month, 7.1%. And then today was kind of the surprise. I mean, it came in better on the core PCE, which got the markets going a little bit. It took the engines a while to start to get going, but then it just started to go down as the day proceeded. And Michigan consumer sentiment final, up a little bit. Then the consensus and down, but down from the previous period. Looking at next week, we have the ISM manufacturing PMI, which continues to just kind of slowly drift downwards. The employment numbers continue to slip down. And we have a whole bunch of speeches from the Fed on Monday. JOLTS job openings on Tuesday kind of give us an indicator of maybe what the unemployment rate is going to look like on Friday. And then we also have the mortgage rate, which, between now and next Wednesday, I don't know, but obviously it went up this this past week, up 0.1%. And then the S&P PMI, the composite, the services component, composite being both manufacturing and service, will be reported on ISM Services PMI. So we got quite a bit of reporting. Don't know whether they're big market movers like a PCE or the CPI or, a Fed funds rate decision, but there's a few things that could potentially move the market. The initial jobless claims down. Let's see. Well, being 204,000, non-farm payrolls probably will move the market, but they always. We're curious to see what the revisions are, as I've talked about in previous episodes. Unemployment rate has been ticking up just a little bit, but it's the revisions here in the non-farm payroll that have gotten at least my attention, and I know a few others. And the markets, just collapse this. The markets this week, this is the daily. We'll see for the weekly how we wound up. The Dow Jones is down. Now it's broken back through this neckline here for this inverse head and shoulders, which is not great news. Now, will it stay there another week? Who knows? So this is kind of breaking through here is a little bit disappointing for bulls that are out there. And then we have the SPX is hanging in there at the moment for this 42.66 level, because I think if it breaks through that, next stop is going to be, I think, the level that the potentially looking at somewhere around 4,200 here. That would fill that gap here at about 42.32. And then the Qs were, you could see it was attempting to fill this gap today, got in there, and I thought we were off to the races, and also this uptrend line that's been going on for a while that we've dipped below, kind of just horseshoed around it and then kind of came back down at the end of the day, but we didn't recapture this trend here. And, now this could be resistance, on this. We'll just have to wait and see what happens next week. IWM, again, another one that started up to fill the gap and then reversed itself, wound up down 84 cents after being up, I think it was $1.60 or so for the day. Maybe more than that, 179.16. So it was up close to probably that was pretty close to $1.60, $1.70. Now, kind of my final comments here are getting into this. I've been mentioning Peter Schiff and David Hunter on their forecasts. And, the expectation is, I believe for both of them, is that the dollar will start getting crushed down. Now, interestingly enough, it started to today, and then it went back up. And for the week, it's still up for the week, closing above this kind of level I put in here. There's nothing magical about it, just where I see a lot of, where I thought there would be a lot of resistance. But it did back off, and so they're both expecting the dollar to kind of begin to turn down, but that has not happened yet, and the strong dollar is starting to be resistance to the markets. And then we have the 10-year yield. This is where they really differ. Peter Schiff is thinking that this thing will continue on up, which would be bad for a number of things, good for commodities, but potentially. And then the David Hunter's expectation is this thing will start to collapse down. So curious to see how this plays out. Still looking. I've got these trend lines that they're moving away from, and I drew some new ones here, but we're still even far away from those. So, David Hunter's expecting to go from where we are now, a little over 4.5%, down to 2.5% over a period of time, probably over the next 9 months or so. And that will be the fuel for the markets for his rally. Peter Schiff is not anywhere close to thinking we're going to get a rally at all. So completely different, looking at these numbers, two completely different things. So that really, as we start to look ahead, there's, I thought this week with PCE coming out and the numbers look pretty good, type of thing, and some of the reports was a mixed bag, but still most of them were showing pretty weak signs. But the problem is when you continue to spend government money like we are, and then scrubbing on one end, by putting dirt on the other, the government putting the dirt on by spending all the money it is just there's no consistency, and the Fed refuses to be independent and call that out. And so they're continuing to raise rates to combat the government spending, but it's nonsensical what we're doing here. But there you go. And I'm not a fan of the tax cuts that the Republicans are planning on. Occasionally listen to Larry Kudlow. Got to get the tax cuts. Well, you got to get the spending cuts if you're going to get tax cuts, and we're still spending like crazy, and then wanting to try and quote unquote grow out of it, but we're never going to grow out of it. There has to be some sanity brought back to government spending, at some juncture, either forced or willingly, and it looks like it's going to have to be forced. So anyway, that's what I wanted to cover this week, and remember, there's always a better way.